Hello and welcome to our discussion on the financial statements. We know that one of the important requirements to undertake financial statement analysis is to understand the interrelationship between the financial statements. The financial statements, that is the balance sheet, income statement and cash flow statement, are interrelated. As a prelude to understanding or undertaking the financial statement analysis, it is necessary to see the interrelationship between these financial statements. So, in that pursuit, we will take an exercise where the balance sheet, opening, closing balance sheet, and the income statement for the period is given, but the cash flow information not given. Even if the cash flow information is not available here, no information on the transaction, it is possible to derive the cash flows because of the interrelationship between the balance sheet, income statement and cash flow. We know that when the changes in the two balance sheets, opening and closing, can be seen or examined or can be understood by seeing the cash flow statement and income statement. So since the opening cash flow, opening balance sheet and the closing balance sheets are given along with the income statement, it is possible to find the cash flows for the period. So we will pick up one by one: cash from operation, cash from financing and cash from investment activities, and then determine the cash flow statement. So cash flow from operation, by using an indirect method, will pick up the profit after tax, which will tell us, that profit is not equal to cash from operation because of non-cash, because of non-operating, and because of the changes in the working capital. So therefore we'll pick up the PAT here. PAT is in this case is 54,600, and PAT is not equal to cash flow, or we can derive the profit, the CFO, by making the adjustments for non-cash items like depreciation, amortizations, and non-operating items like interest and other non-operating items, if any. So let us see that here. So depreciation is a non-cash item, and add depreciation because depreciation is a non-cash item. We are treating interest as a non-operating item, so interest is added back. Then the amortization is an R&D, is a non-operating, so we add back R&D, the amortization of R&D, as non-operating as well as non-cash. So the change in the working capital is the next item. So change in the working capital. Working capital means the changes in the non-cash operating current assets and current liabilities. So therefore, in this case, we'll examine the changes in the current liabilities and current assets, which are stock, debtors. So working capital changes, creditors. If you see the creditors during this period have increased. That means we have purchased the goods on credit, So to that extent, cash has not been paid. So increase in the creditors, increase in creditors will be added back, assuming that that means we have purchased but did not pay money to that extent. Outstanding expense, increase in outstanding expenses, that means we have not paid the expense in that year. So increase in outstanding expenses. Expense has been shown in the income statement, but since the increase in the outstanding expenses happened, so that means we have not paid cash to that extent during that period. Increase in the creditors and increase in the outstanding expenses. Then the debtors have decreased. The decrease in debtors means we made a collection during the period. Decrease in debtors, the debtors or receivables. To that extent, we have collected money from the customers. So the debtors have increased. To that extent, we made a collection. The stock has increased. So increase in the stock or inventory, acquisition of stock without the corresponding payment during the period. So to that extent, we have purchased the goods but we have not paid money. So we can see that the PAT is 54,000, depreciation 1,000 non-cash, interest on long-term liabilities is non-operating, the amortization of R&D is a non-operating and non-cash, increase in creditors is 10,000, increase in outstanding expenses 2,000, decrease in debtors 30,000, and increase in stock, we have paid money. Increase in stock, that means we purchased stock and did not pay money, and so we purchased the stock during the period and not used, so therefore it is treated as a outflow of cash to that extent. So CFO for the period is equal to 115,600. Now we'll see cash from financing, which can be seen by examining the changes in the capital, premium, reserves and liabilities and the payment of interest. First we will see the receipts from cash from financing. There is an increase in the capital, so there is an issue of shares, and that too at a premium. So issue of shares during the period is a receipt 25,000 minus 5,000, and there is a premium, that means the shares have been issued at a premium. So there is a premium, issue of shares has happened at a premium, and the reserves have changed, but the reserves has changed not to the extent of the PAT. So that means we have paid the dividend. So the dividend, the change in the dividend, the change in the reserve will be treated as the dividend here. So the dividend is equal to opening reserve plus the current PAT minus the closing reserves will give us the dividend, but the dividend is a payment. So to that extent we have paid dividend. So the distribution of profit during the period is minus 15,000. We can also see that the loan, there is a loan payment, loan repayment because the loan has gone down, loan has decreased during the period, and that is equal to 25,000 minus 15,000, so minus 10,000. And we paid interest during the period, interest payment, interest on the loan is equal to, interest on loan is 3,000. So the CFF will be 50,000 issue of shares, 10, 20 plus 30. Interest payment is 3,000. The dividend payment is 15,000. The loan repayment is 10,000. So the summation of all these cash flows should give us the cash from financing. So cash from financing is 22,000 CFF. Then we'll see cash from investment, which will be known by observing the changes in the property, plant and equipment and R&D, because we have taken R&D as a non-current, non-operating assets. So there is no receipt because we have not received any income from other sources, so there is only payments here. So cash from is a purchase of the plant, during the period. We can see the plant was 20,000 or is 34,000, then plus depreciation minus the opening will give us that plant has been acquired to the extent of 15,000. In other words, during the period we acquired plant for or costing 15,000, which can be seen by observing the difference between the plant and adding depreciation to that. So changes in the plant plus the depreciation will show the capex during the period. We have also made an R&D, acquired R&D was not there, so R&D is equal to the changes in the R&D plus the amortization of R&D during the period, plus the amortization during the period. So acquisition of R&D during the period is 60,000. That means we acquired R&D worth of 60,000 and amortize it, 1/3 of it during the period. So therefore there is a CFF 75,000. So CFO 115,000, CFF is 22,000 and CFI minus 75,000. The summation of this should be equal to cash in hand on the balance sheet, and the cash in hand on the balance sheet is 102,600 is here 102,600. So if the information about the balance sheet is given, income statement is given, even if the cash flow informations are not there, it is possible to derive the cash flow statement because of the interrelationship between these financial statements. And one need to understand this interrelationship as a prelude to undertaking a detailed analysis of the financial statements. Thank you very much.